Hello, friends. Today, we're diving into one of the greatest stock market books of all time, Reminiscences of a Stock Operator. This book is not just a story. It's a masterclass in trading psychology, market strategy, and the harsh realities of speculation. Written by Edwin Lefevre, this book is a semi-autobiographical account of Jesse Livermore, one of the most legendary traders in history. It takes us through his incredible journey, from a young boy trading in bucket shops to becoming one of the richest and most notorious traders on Wall Street. If you're into stock trading, investing, or just love a gripping financial story, then this book is a must-read. It teaches powerful lessons about risk, discipline, emotions, and the brutal truth of the markets. So, if you're ready to explore how fortunes are made and lost in the stock market, hit that like button, share this video with fellow traders, and don't forget to subscribe to the channel for more deep insights into stock market classics. Now, let's get started with the first chapter. Stock trading is like a battlefield, and every trader must learn the hard way. That's exactly what young Jesse Livermore discovered when he first stepped into the world of speculation. He wasn't born into wealth, nor did he have a formal education in finance. But what he did have was an extraordinary ability to read the tape, the stream of stock prices that revealed the market's heartbeat. At just 15, Jesse started working at a brokerage office, writing down stock prices on a chalkboard. It was here that he observed something fascinating. Prices moved in patterns. While others simply saw numbers, he saw trends, behaviors, and opportunities. His natural instinct for tape reading was his biggest asset. Despite being just a teenager, Jesse began placing small bets in bucket shops, places where traders could gamble on stock prices without actually buying shares. Unlike Wall Street brokers, these shops didn't execute real trades. They just took bets. This gave Jesse a low-risk playground to test his theories. He quickly realized that the market had a rhythm. Stocks moved in predictable ways, and he could profit by following these movements. And that's exactly what he did. With a method based purely on observation, Jesse started winning, again and again. While other traders relied on tips and gut feelings, he used logic and pattern recognition. His winnings grew, but so did the attention on him. The bucket shop owners didn't like consistent winners. They were in the business of making money from losers, not paying out to sharp young traders like Jesse. As he kept winning, he was eventually banned from every bucket shop in town. But instead of feeling defeated, Jesse saw it as confirmation. His strategy worked. Now he faced a new challenge. If he could beat the bucket shops, could he also beat Wall Street? This chapter sets the foundation for Jesse's journey. He wasn't just another gambler. He was a market observer, a thinker, and a strategist. The lessons he learned in bucket shops would shape his approach to trading for years to come. But his real test was yet to begin. Stepping into the real stock market, where fortunes could be made or lost in an instant. Chapter 2. Jesse Livermore had conquered the bucket shops, but that was just the beginning. Beating small-time operators was one thing. Taking on Wall Street was an entirely different challenge. After getting banned from every bucket shop in town, Jesse knew he had no choice but to step into the real stock market. So, with his savings in hand, he moved to New York. He had been a big fish in a small pond, but now he was playing with sharks. Unlike bucket shops, where trades were just bets on price movements, here real stocks were being bought and sold. The rules were different, and so were the stakes. His first experience in a legitimate brokerage house was eye-opening. The commissions were higher, and he couldn't trade on tiny margins like before. More importantly, the speed was different. In bucket shops, he could see prices move instantly, but on Wall Street, orders took time to execute. This delay was enough to throw off his entire strategy. Jesse made his first few trades based on the same patterns he had mastered in the bucket shops. But it didn't work. He started losing money, and for the first time, doubt crept in. Could it be that his methods were useless in the real market? But Jesse wasn't one to give up easily. Instead of blaming the market, he analyzed his mistakes. The biggest lesson? The game was different here. The stock exchange had larger players, deeper pockets, and more influence over prices. He realized he needed to adapt. Instead of just watching the tape, he started paying attention to the overall market sentiment. He noticed that big moves weren't just about individual stocks, but were influenced by the broader economy, news, and market conditions. His early losses were a hard lesson, but they gave him something invaluable, a new perspective. The market wasn't just numbers on a board, it was a reflection of human psychology, emotions, and fear. Despite the rough start, Jesse knew he was onto something. He had learned a critical truth. What worked in small, controlled environments wouldn't necessarily work in the real market. If he wanted to succeed, he had to evolve. Chapter 3. Jesse Livermore had tasted failure on Wall Street, but instead of walking away, he saw it as a challenge. He realized that while his tape-reading skills were sharp, they weren't enough on their own. The real market required a deeper understanding, one that went beyond just watching price movements. Determined to bounce back, Jesse refined his approach. Instead of jumping into trades impulsively, he started focusing on patterns in the market. He noticed that stocks didn't just move randomly, there were trends, and these trends were driven by larger forces. He needed to learn patience, something he had ignored in the past. With a fresh mindset, Jesse returned to trading, but this time he was careful. He no longer rushed into positions. Instead, he waited, watching for the perfect moment to strike. And when he did, it paid off. His wins started to outweigh his losses, and slowly but surely, he built back his capital. But just as things were looking up, he made a critical mistake. Feeling confident after a series of successful trades, he took a big position, too big. He bet heavily on a stock, convinced that it would move in his favor. But the market had other plans. The stock didn't move as expected, and before he knew it, he had lost almost everything. It was a crushing blow, but instead of blaming bad luck, Jesse took full responsibility. He realized that emotions were his biggest enemy. Overconfidence had led him to break his own rules, and the market had punished him for it. Out of money, and with no way to trade, Jesse had to start from scratch. But he wasn't defeated. If anything, he was more determined than ever. He knew he had the skills, but he needed discipline. This lesson would stick with him for the rest of his life. The market rewards those who wait for the right opportunity, not those who act on impulse. Jesse's losses weren't the end of his journey. They were just another step in his evolution. He would return, but this time, he would trade not just with his eyes, but with his mind. Livermore had been humbled by his mistakes, but he wasn't ready to quit. He had lost his trading capital, but not his determination. Instead of giving up, he found a way back. He borrowed money, small amounts at first, and began trading cautiously. This time, he was focused on learning from his past errors. One of his biggest realizations was that stock prices didn't just move because of numbers on the tape. There was a rhythm to the market, a hidden force driving prices up and down. It wasn't just about reading the tape, it was about understanding market behavior. Jesse started paying close attention to how stocks acted rather than just what the ticker tape showed. He noticed that certain stocks moved in predictable ways before big price swings. If a stock didn't behave the way it should, he stayed away. It was a simple rule, but a powerful one. If a stock doesn't act right, don't touch it. No diagnosis, no prognosis. No prognosis, no profit. At the same time, Jesse observed other traders, especially the so-called ticker hounds, people obsessed with following every single market movement. They relied too much on rigid systems and mathematical formulas, believing that past price patterns could predict the future with certainty. But Jesse saw their flaw. They were missing the human side of the market. One example was a French trader who claimed to have a mathematical system that could predict stock movements with charts and statistics. He even impressed big Wall Street traders. But when a major, unexpected event like the outbreak of World War I happened, his system collapsed. The market wasn't just numbers. It was emotions, fear, and greed. Jesse learned that no formula could replace experience, instinct, and flexibility. The market wasn't mechanical. It was a living, breathing entity shaped by the decisions of thousands of traders. And the best way to succeed wasn't to follow rigid rules, but to adapt to changing conditions. Through this, Jesse refined his approach. He no longer traded just because the tape told him to. He combined his tape-reading skills with a deeper understanding of stock behavior and human psychology. He knew that traders who blindly followed patterns without thinking for themselves were doomed to fail. With these insights, Jesse was ready to trade again, this time with a sharper mind and a stronger strategy. His losses had taught him more than any winning streak ever could. He wasn't just a tape reader anymore. He was becoming a true speculator. Jesse Livermore had come a long way, but he was still refining his trading approach. This chapter dives into one of the biggest mistakes traders make, over-relying on patterns and formulas without understanding the real forces behind market moves. Many traders, whom Jesse called ticker hounds or tapeworms, were obsessed with reading the tape, believing that past patterns alone could predict future stock movements. But Jesse saw the flaw in their thinking. While the market did follow certain laws, it wasn't a mathematical puzzle. It was driven by human emotions, speculation, and real-world events. One of the key lessons he learned was about stock behavior. It wasn't enough to see a stock moving up or down. He had to understand how it moved. If a stock didn't act right, he avoided it. No guessing, no hoping. If it wasn't behaving the way it should, there was something wrong, and that meant risk. He recalled a French trader who had developed a detailed system of market charts, claiming they could predict stock movements with near-perfect accuracy. Some traders tested the system, but eventually they abandoned it. Why? Because markets weren't just numbers, they were people. And people don't always follow predictable patterns. Even brilliant traders with complex systems eventually hit a wall. One highly skilled mathematician created an advanced trading system based on years of historical data. He used it successfully until World War I broke out. Suddenly, all his calculations meant nothing, and he lost millions. That's when Jesse understood another golden rule. Markets change, and rigid strategies will fail when the world shifts. Jesse had his own struggles. Now trading with real brokers instead of bucket shops, he was adjusting to a new level of risk. He was winning more often than losing, but he still hadn't mastered the difference between gambling and speculation. He realized that success wasn't just about making trades, it was about making smart trades. His earnings went up, and so did his spending. Like most traders, he found that easy money was easy to lose. He wasn't hoarding wealth. He was living fast, enjoying the highs of the market without thinking much about the long term. But something inside him knew he still had a lot to learn. This chapter highlights the critical shift in Jesse's thinking. He moved beyond tape reading and started seeing the market for what it really was, a battlefield of psychology, strategy, and adaptability. He wasn't just reacting anymore. He was learning to anticipate. In the spring of 1906, Jesse Livermore took a break from trading and went to Atlantic City for a short vacation. He wasn't thinking about stocks, just fresh air and relaxation. But as he would soon realize, the market had a way of calling him back. By this time, he had returned to his original brokerage firm, Harding Brothers. His trading had grown, and he could now handle 3,000 to 4,000 shares per trade. But there was still a big difference between his old bucket shop days and real stock market trading. In bucket shops, he operated on razor-thin margins, but now he was playing with real money, where the stakes were much higher. While in Atlantic City, Jesse experienced something he had felt before, a strong hunch. He had learned over the years that these gut instincts weren't random. They weren't caused by too many cigars, lack of sleep, or even nerves. It was something deeper, a subconscious understanding of the market that he couldn't always explain. One morning, after breakfast, he and a friend were strolling along the boardwalk. Out of habit, they stopped by the local branch of Harding Brothers to check the stock prices. The market was strong and bullish, and his friend, who had bought stocks at lower prices, was feeling confident. He kept telling Jesse how obvious it was that the market would go even higher. Jesse wasn't paying much attention until he glanced at the ticker and saw Union Pacific. And then it happened. He suddenly felt the need to sell it. He couldn't explain why. There was no news, no visible sign of weakness, just a strong inner voice telling him to get out. For a moment, he tried to argue with himself. Why should I sell? The market is strong. There's no logical reason. But the feeling wouldn't go away. He kept staring at the board until everything else faded. His friend nudged him, snapping him out of his trance. "Hey, what's the matter?" Jesse replied, "I don't know, but I have to sell that stock." And with that, he acted. This chapter marks a turning point. Jesse had always relied on logic and strategy, but now he was starting to recognize the power of intuition, his ability to feel the market before it moved. This wasn't luck. It was the result of years of watching, studying, and experiencing the market firsthand. His brain had picked up on something, even if he couldn't explain it at the time. And as we'll see, following this instinct would be one of the most important decisions he ever made. Jesse Livermore followed his instinct and sold Union Pacific. But he didn't stop there. Something inside him told him the market was about to turn, so he started shorting more stocks. It was still a bullish market, and most traders saw no reason for concern. But Jesse had learned to trust his gut, even when logic and public sentiment said otherwise. After placing his trades, he went back to enjoying his vacation. He wasn't glued to the ticker tape, nor was he second-guessing his decision. He had been in the market long enough to know that once a trade was made, the waiting game began. Then, just a few days later, the news broke. On April 18, 1906, a massive earthquake struck San Francisco. The devastation was unprecedented. Fires raged for days. Thousands were killed, and the financial impact was enormous. Wall Street panicked. Stocks that had been steadily climbing suddenly collapsed. Investors scrambled to sell, and Jesse's short positions started paying off in a big way. He had acted before anyone else, before the news, before the logic. His instincts had put him ahead of the market once again. His friend, who had been bullish just days earlier, was in shock. "How did you know?" he asked. Jesse didn't have an answer. "I didn't know. I just felt it." This trade was a defining moment for him. It reinforced the lesson that the market isn't just about numbers or news. It's about behavior. It reacts in ways that aren't always logical. And if you can learn to sense those movements before they happen, you can stay ahead. By the time the dust settled, Jesse had made a small fortune. But more than the money, he had gained something even more valuable: absolute confidence in his ability to read the market's pulse. And that's the lesson of this chapter. Sometimes the best trades aren't based on news or analysis, but on intuition honed through experience. The market doesn't always make sense, but if you learn to listen, it will tell you everything you need to know. After the San Francisco earthquake, Jesse Livermore was riding high on his successful short trades. His instincts had once again put him ahead of the market. But if there's one thing he had learned by now, it was that success in trading is never permanent. It only lasts as long as your discipline does. With his newly gained fortune, Jesse was confident, but he also understood that the market was constantly changing. He didn't let success cloud his judgment. Instead, he focused on what came next. By now, he had solidified his belief that stock prices don't move randomly. They follow patterns based on human behavior: fear, greed, panic, and euphoria. This wasn't about just reading the ticker tape. It was about reading people. But even with this understanding, Jesse was still learning. He had yet to fully grasp the importance of patience in trading. Just because he was good at making money didn't mean he was equally good at keeping it. Around this time, Jesse made a mistake that nearly cost him everything. He ignored his own rules. The market had started recovering, and Jesse, instead of waiting for confirmation, jumped back in too early. He went long on stocks that hadn't fully stabilized yet. His reasoning? He had made the right call before, so why not now? But the market doesn't care about past victories. It punishes overconfidence. Within days, stocks reversed again, and Jesse found himself trapped in losing trades. He had let his recent success cloud his judgment, and this time, he paid the price. He watched as his profits evaporated, proving yet another hard lesson. It's not about how much you make, but how much you keep. Jesse was forced to take a step back. He realized that just because he had a great run didn't mean he was invincible. The market has a way of humbling even the best traders. This chapter highlights one of the biggest lessons in trading: the danger of overconfidence. The moment you start believing you can't lose, you're already in trouble. Jesse had to learn the hard way that even the best instincts mean nothing if you don't respect the market's unpredictability. Jesse Livermore had just faced a harsh reality check. Overconfidence had wiped out a significant portion of his gains. But like any great trader, he knew setbacks were part of the game. The real challenge wasn't avoiding losses, but learning from them. By now, Jesse had developed a deeper understanding of the market's nature. He knew that speculation wasn't just about picking the right stocks, it was about timing. No matter how strong your conviction, if you enter too early or too late, you're setting yourself up for failure. During this period, he started refining his approach. He realized that instead of reacting to every little move, he needed to focus on confirmation. If a stock was going up, he wouldn't just jump in, he'd wait for it to prove itself. Likewise, if he sensed weakness, he wouldn't rush to short. He'd let the market show its true colors first. This shift in strategy was crucial. Jesse was beginning to see that speculation was more than just instincts. It was patience and discipline. But his journey was far from smooth. Despite his growing experience, Jesse still found himself struggling with a common trader's dilemma: when to take profits. He often sold too early, afraid that the market might reverse. Other times, he held on too long, hoping for even bigger gains, only to watch the price turn against him. This back-and-forth battle with emotions was exhausting. He knew he had to find a way to control his impulses. One of the biggest lessons Jesse learned in this phase was that the market is never obvious. The moment something seems like a sure thing, it's probably a trap. The professionals don't trade based on hope. They trade based on data, trends, and logic. Jesse had to remind himself that the market wasn't about being right all the time. It was about managing risk and maximizing the times he was right. He was getting closer to mastering his craft, but there was still one more crucial lesson ahead: understanding the market cycle and how big trends develop. This chapter serves as a reminder that even experienced traders struggle with timing, emotions, and discipline. But those who learn from their mistakes and adapt will always have an edge. Jesse Livermore was no longer just another trader. He was becoming a market operator. But with experience came bigger risks and sometimes bigger mistakes. This chapter highlights a crucial turning point in his journey: learning to recognize major market shifts before they happen. By this time, Jesse had already made and lost multiple fortunes. He understood that the stock market wasn't just about individual stocks. It was about the overall market trend. If he could spot when the market was about to change direction, he could position himself ahead of the crowd. One of his biggest realizations was that news follows the market, not the other way around. The public waits for headlines to confirm their beliefs, but professional traders anticipate the move before the news breaks. This insight gave Jesse a massive edge. He stopped trading based on rumors and started focusing on the market's actual behavior. During this phase, Jesse also struggled with a common trader's pitfall: overtrading. The urge to constantly be in the market was strong, but he had to remind himself, there's a time to be in the market and there's a time to wait. He also learned that in speculation, hope is your worst enemy. Many traders hold on to losing positions, hoping the market will reverse. But Jesse knew that the best traders cut their losses quickly and let their winners run. At one point, Jesse found himself caught in a bad position. He was too stubborn to admit he was wrong. He watched as the market moved against him, draining his capital. It was a painful lesson, but it reinforced a rule he would live by. The stock market is never wrong. Your opinion can be wrong, but the market is always right. This chapter emphasizes the importance of recognizing market trends early, avoiding overtrading and waiting for the right moment, letting go of personal biases, and respecting the market. Jesse was refining his skills, but his biggest challenge was still ahead: learning how to ride major trends without getting shaken out. By this point, Jesse Livermore was no longer just trading. He was strategizing. His ability to read the market was improving, but now he faced a different challenge: sticking to his own rules and resisting emotional impulses. One of the key takeaways from this phase in his life was understanding that big money isn't made by jumping in and out of trades. It's made by sitting tight when you're right. Too many traders book small profits too soon, fearing a reversal. But Jesse realized that the real gains come when you ride a trend for as long as possible. A critical event during this time was his experience with a major bull market. The market was rising steadily, and he had positioned himself correctly. But instead of holding, he took profits too soon, only to watch the stocks he sold continue climbing without him. It was a frustrating lesson, but it confirmed something he already suspected. Men who can both be right and sit tight are uncommon. This chapter also introduces the mental battle of speculation. Even when Jesse was winning, he wasn't immune to doubt. There were moments when he questioned his decisions, hesitated on making moves, or second-guessed a successful strategy. But he learned that confidence in your own method is everything. Jesse also observed how different types of traders reacted to market movements. He noticed that many speculators got caught in the same cycle. 1. They jump into a trade based on tips or emotions. 2. They panic at the first sign of trouble. 3. They either sell too early or hold on to losers for too long. These patterns helped him refine his strategy. He focused on market behavior, not opinions. He trained himself to wait for confirmation rather than acting on impulse. Perhaps the most important lesson from this chapter is this: the market doesn't care about your emotions. It moves how it moves, and your job is to align with it, not fight it. Jesse was sharpening his discipline, but the biggest tests were yet to come. Would he be able to maintain this mindset when faced with extreme market swings? By now, Jesse Livermore had mastered many aspects of trading, but a crucial challenge remained: controlling his own impulses. Knowing what to do was one thing, actually doing it under pressure was another. At this stage, he had accumulated significant profits, yet he still struggled with one key weakness: overtrading. The temptation to constantly be in the market was strong, even when conditions weren't ideal. He realized that the biggest danger wasn't just making mistakes, it was making mistakes while over-leveraged. One day, after a successful string of trades, he found himself feeling overconfident. He jumped into the market again, assuming his winning streak would continue. But the market doesn't care about past wins. It only reacts to present conditions. That overconfidence led him into a bad position, and he lost a large portion of his gains. This was when he reinforced one of the greatest lessons in speculation. The desire for constant action is one of the biggest enemies of successful trading. The best traders don't trade all the time. They wait, they watch, they strike only when the conditions are right. Jesse learned that sitting on cash, waiting for the perfect opportunity, was far more powerful than forcing trades out of boredom or greed. But another major realization was taking shape. He started to recognize that the stock market isn't just numbers, it's people. Stocks don't move randomly, they move based on human behavior. Greed, fear, hope, and panic control the market more than logic. Reading the market meant reading the emotions of other traders. This is when Jesse truly started thinking like a market psychologist. He wasn't just analyzing charts, he was analyzing the minds behind the trades. He noticed how amateurs reacted to price swings, how professionals manipulated stocks, and how the public always arrived too late. He also began refining his strategy further. 1. Wait for the right moment. Not every move is worth taking. 2. Let winners run. Small profits are nothing compared to big trends. 3. Don't overtrade. Trading too often leads to unnecessary losses. 4. Understand market psychology. Fear and greed dictate price action. Jesse was evolving into a true market operator, not just a trader. But the real test of his discipline was still ahead. Would he stick to his new insights when the market threw its next big challenge at him? Jesse Livermore was making real progress as a trader. He had learned to control his impulses, read market psychology, and avoid overtrading. But a new challenge was about to test his skills: the market's unpredictability. At this point, he had refined his approach to trading. He understood that success wasn't about picking random stocks, it was about identifying the right conditions. He had seen how stocks behaved before major moves and learned to recognize those signals. But even with all his experience, the market remained a battlefield where nothing was guaranteed. One of the biggest obstacles he faced was public sentiment. The majority of traders acted based on emotions, chasing rising stocks in greed and dumping falling stocks in fear. Jesse knew that following the crowd was dangerous, but it was still tempting at times. A classic trading trap. There was a period when Jesse felt particularly confident. He had made a few winning trades in a row and decided to take a large position in a stock he believed was ready to move higher. The market conditions seemed perfect. The trend was strong. The stock looked poised for a breakout. Then, out of nowhere, bad news hit the market. Stocks that had been climbing suddenly reversed. His position, which had seemed so promising, was now bleeding money. This was a critical moment. Would he panic and sell like everyone else, or would he stick to his plan? Instead of making an emotional decision, he analyzed the situation rationally. The market had changed. The conditions that made him bullish were no longer valid. Rather than hope for a reversal, he cut his losses immediately. This was a major turning point in his career. He had learned another crucial rule. When a trade isn't working, get out fast. Hope is not a strategy. It was this ability to stay flexible that separated him from amateur traders. The market was unpredictable, but instead of trying to fight it, he adapted. The power of observation. Jesse also realized that watching the market was just as important as trading. By stepping back and observing price movements, he could spot repeating patterns. He noticed that stocks often telegraphed their next move if you paid attention. When a stock hesitated near a high, it often meant resistance. When a stock couldn't rally after bad news, it showed strength. When a stock kept rising despite good news, it was likely overbought. Most traders reacted to price moves. Jesse started anticipating them. This mindset shift was huge. It meant that instead of trading based on emotion, he was now trading based on probabilities. He understood that no trade was ever certain, but by stacking the odds in his favor, he could make consistent money over time. Jesse now had a set of ironclad rules. 1. Cut losses quickly. Never hold on to a losing position in hope. 2. Stay flexible. If the market changes, adjust your strategy. 3. Watch before you trade. Great trades come from careful observation. 4. Don't trust public sentiment. Most people get in too late. With these principles guiding him, Jesse was becoming one of the sharpest operators on Wall Street. But the biggest test of his skills was yet to come. Would he be able to predict the next market collapse? Jesse Livermore had mastered the art of trading, but now came a bigger challenge: navigating market cycles on a larger scale. He had seen stocks move in patterns, but could the entire market itself be predicted? This was when he started thinking beyond individual stocks and focusing on the overall market trend. A bull market at its peak. The stock market had been rising steadily, and traders were more confident than ever. Everywhere Jesse looked, people were optimistic. Newspapers were filled with bullish predictions. Experts insisted that prices would continue to climb. This was exactly what worried him. When everyone is confident, the market is often at its most dangerous. Jesse had seen it before. The moment the crowd gets too comfortable is when things start to fall apart. A gut feeling or a calculated prediction? One day, while analyzing the markets, Jesse had a strange feeling. Something wasn't right. The stocks that had been leading the rally were no longer making new highs. Some of the strongest stocks were stalling. Meanwhile, weaker stocks were beginning to fall. This was a clear warning sign. When the best stocks struggle while the weaker ones collapse, it means the market is losing strength. Most traders ignored it. The news was still bullish. The economy seemed fine. But Jesse knew better. Making the big move. Instead of following the crowd, Jesse made a bold decision. He started shorting stocks. He bet against the stocks that were showing weakness. He positioned himself to profit if the market crashed. He ignored the noise and focused on the signals he saw. At first, nothing happened. Stocks kept floating higher, and traders mocked his bearish stance. But Jesse had patience. He had seen this play out before. And then it happened. A sharp sell-off shook the market. Stocks that had been rising steadily for months suddenly collapsed. Traders panicked. People who had been blindly buying at the top were now rushing to sell. Jesse? He was sitting on a fortune. His ability to read the market cycle had paid off. While everyone else was losing money, he was making one of the biggest profits of his career. Jesse Livermore had just made a fortune by correctly predicting the market downturn. But as always, the real challenge wasn't just making money, it was keeping it. Overconfidence, the trader's worst enemy. After a big win, many traders fall into a dangerous trap. They believe they can't be wrong. Jesse had made one of the best calls of his career, but instead of stepping back and reassessing, he got too confident. His success made him feel invincible. He had outsmarted the market before, so why wouldn't he do it again? Jumping back in too soon. The market had crashed, but it wasn't staying down forever. A new rally began, and stocks started recovering. Jesse saw this, but instead of patiently waiting for a clear opportunity, he jumped in too early. He started shorting stocks again, expecting another downturn. But this time, the market wasn't listening. Stocks kept climbing, and Jesse found himself trapped. He ignored the signs that momentum had shifted. He held on too long, convinced that the market would prove him right. He let his ego take control instead of following his own trading rules. And just like that, he lost everything he had just made. Learning the hard way, Jesse realized something crucial. It wasn't enough to predict the market. Timing was everything. Being right too early is the same as being wrong. Winning streaks can create blind spots. After a big win, traders tend to overestimate their abilities. The market doesn't care about past success. Every trade is a new battle. Discipline matters more than confidence. No matter how good you are, you have to respect the market. A fresh start, again. Jesse was broke, but this wasn't the first time he had lost everything. Instead of giving up, he did what he always did. He went back to analyzing the market, learning from his mistakes, and preparing for his next big move. Because in trading, it's never about a single win or loss. It's about staying in the game. Jesse Livermore had lost his fortune, again, but if there was one thing he knew how to do, it was starting over, rebuilding from rock bottom. Most people, after losing millions, would give up, but Jesse had already been broke before, and he had always bounced back. Instead of sulking, he went right back to doing what he did best, studying the market, observing price movements, and waiting for the perfect moment. This time, though, he was more cautious. He knew that his biggest enemy wasn't the market. It was his own impatience and overconfidence. Understanding market cycles. Livermore started noticing something important. The market always moved in cycles. First, stocks would rise slowly, with only a few smart investors buying in. Then, as confidence grew, more people would jump in, driving prices higher. At the peak, everyone would be buying, convinced the rally would never end. But when the market had gone up too much, big players would start selling quietly. Eventually, panic would hit, and the market would crash. Jesse realized that his past mistakes came from not respecting these cycles. He had been too early in calling tops and bottoms, which led to huge losses. This time, he did something different. He waited. Instead of forcing trades, he focused on patience. He knew that a big opportunity would come, and when it did, he needed to have the capital to take full advantage. His patience paid off. He saw a clear uptrend forming and jumped in at the right time. He let his profits run instead of selling too early, and when the signs of a downturn appeared, he exited before the crash. Slowly but surely, Jesse rebuilt his fortune. The market is bigger than you. Jesse had finally learned one of the most important lessons of trading. You don't control the market controls you. No matter how skilled or experienced you are, the market moves on its own terms. Your job isn't to fight it, it's to understand it, respect it, and move with it. Jesse Livermore was back in the game. He had rebuilt his fortune, learned from his past mistakes, and was now trading with more patience and discipline than ever before. But the one thing that haunted him, the emotional toll of trading. The psychological battle. Livermore knew that success in trading wasn't just about reading charts or understanding market cycles, it was about controlling your emotions. Fear made traders panic and sell too early. Greed made them hold on too long. Overconfidence led to reckless bets. Doubt caused hesitation, missing big opportunities. Livermore had battled all of these emotions before, and even after years of experience, they still crept in. He realized that his greatest enemy wasn't the market, it was himself. The temptation of public opinion. One of the biggest mistakes traders make is listening to the crowd. Livermore knew that whenever the general public was overly bullish or bearish, it was usually a sign that the market was about to move in the opposite direction. When everyone was buying, it meant the market was overinflated. When everyone was panicking and selling, it meant a recovery was near. But resisting the influence of public opinion was easier said than done. Even the most experienced traders could get caught up in the noise. The burden of wealth. By now, Livermore was making millions again. But with great wealth came great pressure. He was constantly in the spotlight. Everyone wanted to know what trades he was making. He felt the weight of expectations from those around him. He realized that the more money he made, the more stressful trading became. Why? Because when he was broke, he had nothing to lose. But now, every trade carried the risk of losing everything. Again. Recognizing market manipulation. Livermore also learned another hard truth. The stock market was not a level playing field. Large institutions and powerful investors could manipulate prices. Stocks didn't always move on pure supply and demand. Big money controlled the game. Rumors were spread deliberately to mislead traders. He had to be extra careful not to fall into traps set by those with deeper pockets and inside information. Discipline over emotion. Livermore's biggest realization was that the best traders weren't just great analysts. They were great at managing their emotions. They knew when to stay out of the market. They understood that not every day was a trading day. They accepted losses as part of the game and moved on quickly. This chapter highlights one of the biggest truths about trading. It's not about being right all the time. It's about staying disciplined when it matters most. Jesse Livermore had seen it all. Booms, busts, bull markets, bear markets. He had made fortunes and lost them, only to make them back again. But as his career advanced, so did the complexity of the markets and the challenges of being a trader at the highest level. The danger of overtrading. One of the biggest threats Livermore faced was the temptation to always be in the market. When things were going well, he felt invincible and wanted to keep making money. When he was losing, he wanted to trade more to recover quickly. This is what many traders today call revenge trading, the emotional response to losses that leads to more mistakes and bigger losses. Livermore had to remind himself that trading wasn't about constant action. It was about strategic patience. The market as a living entity. Over time, Livermore began to think of the market as a living, breathing thing with its own moods, rhythms, and behaviors. Some days it was predictable and stable. Other days it was wild and irrational. Sometimes it gave clear signals, and other times it sent false messages to trap traders. He understood that fighting the market was a losing battle. Instead of forcing trades, he had to wait for the market to tell him what to do. This was a hard lesson because, by nature, Livermore was aggressive. He wanted to act, but he learned that his biggest wins came when he waited for the perfect moment. Understanding market cycles. One of Livermore's greatest strengths was recognizing the repeating cycles of the market. Boom periods were always followed by crashes. Panic selling was usually followed by recoveries. Stocks that had gone up too fast would eventually come crashing down. These patterns were driven by human psychology. Fear and greed never changed. The key was to stay ahead of the cycle. Livermore wasn't just reacting to the present, he was always thinking 3 steps ahead. The illusion of easy money. By now, Livermore was one of the most famous traders in America. People looked at him as someone who had a magic touch, someone who could make millions out of nothing. But he knew the truth. There was no magic. There were no shortcuts. The market didn't care who you were. It punished overconfidence and rewarded discipline. The reason most traders failed wasn't because they weren't smart enough. It was because they weren't disciplined enough. The pressure of being a legend. As Livermore's wealth and reputation grew, so did the pressure. He couldn't trade like he used to. His moves were watched closely, and if people knew what he was doing, they would copy him. He had to be careful not to tip off the market when making large trades. He had to balance his instincts as a trader with the realities of being a public figure. This was an entirely new challenge. Before, he was just another trader. Now, he was a legend, and that made trading even harder. The key lesson: the market is bigger than any trader. Livermore had played and won the game for years, but he knew the market was always stronger. It didn't matter how much money he had. One wrong move could wipe him out. It didn't matter how famous he was. The market had no loyalty to anyone. No matter how much success he had, he was never truly safe. He had learned the hard way that confidence was necessary, but overconfidence was deadly. At this stage in his life, Livermore was at the peak of his career. But as history had shown, his greatest wins were often followed by devastating losses. Jesse Livermore had seen the highest peaks of success, but he knew better than anyone that the market could turn against even the smartest traders. The more he traded, the more he realized that surviving in the market wasn't just about strategy. It was about controlling emotions, managing risks, and knowing when to step back. The trap of public attention. By now, Livermore wasn't just a trader. He was a legend. His moves were closely watched by other traders, the press, and even big financial institutions. If he bought a stock, others would rush to buy it too, driving the price up before he could complete his purchase. If he shorted a stock, panic selling could start before he was fully positioned. This made trading far more difficult than when he was just another speculator in the crowd. The market is a game of deception, he often reminded himself. But now he was the one being watched, and that meant he had to be even more careful with every move. Overconfidence versus discipline. Livermore had made millions by trusting his instincts and following his trading rules, but success had a way of creating overconfidence. When he was on a winning streak, he sometimes felt unstoppable. He had to remind himself that the market didn't care about his past victories. He had learned, sometimes the hard way, that the moment a trader starts to believe they are bigger than the market humbles them. This was one of the biggest battles Livermore faced, not with the market, but with himself. Recognizing the early warning signs. Livermore had developed an extraordinary ability to sense when something was about to change. Sometimes it was in the price action, a stock moving differently than expected. Sometimes it was in the broader market, sentiment shifting, patterns breaking. And sometimes it was just a gut feeling, that unexplainable instinct that had saved him before. One of the key lessons he had learned was to trust those warning signs. Whenever he ignored them, he paid the price. The market is never easy money. Despite all his success, Livermore never lost sight of one truth. The market is never easy. If it seems easy, you're probably about to make a mistake. Many traders made the mistake of thinking a bull market meant they were geniuses. They won trade after trade and believed they had mastered the game, but Livermore knew better. He had seen traders rise and fall, and he understood the real test wasn't winning in a strong market. It was surviving when things turned. The unseen dangers of trading. As Livermore continued to trade at a high level, he started to notice a new type of danger, the mental toll of trading, the constant pressure of handling large sums of money, the fear of making a wrong move, the emotional roller coaster of wins and losses. Livermore understood that many traders weren't beaten by the market, they were beaten by their own emotions. Some traders became overconfident and reckless. Others became fearful and paralyzed. Livermore had experienced both extremes, and he knew that to stay in the game, he had to stay emotionally balanced. Adapt or perish. Markets never stay the same. What worked yesterday might not work tomorrow. The best traders weren't just skilled, they were adaptable. Livermore had learned that success in the market wasn't just about making the right trades. It was about knowing when to adjust, when to step back, and when to trust your instincts. Jesse Livermore had seen enough bull and bear markets to know that the game never stays the same for long. He had made and lost fortunes. And now he was at a stage where the stakes were higher than ever. Every decision could either secure his financial legacy or lead to another devastating fall. The market's silent warnings. Livermore had always believed that the market sends signals before making a major move. But the problem was, most traders ignored them until it was too late. When stocks moved in unexpected ways, he took it as a sign. When sentiment shifted too quickly, he knew something bigger was happening. When everything felt too good to be true, he reminded himself that it probably was. The biggest mistake traders made? Thinking the good times would last forever. Livermore had already been through enough crashes to know better. The market never just gives money away. It always finds a way to take it back. The dangers of success. By now, Livermore was one of the most famous traders in the country. But with fame came problems he had never faced before. Every trade he made was being watched. Big firms, small traders, and even the press were analyzing his moves. His own success became his biggest enemy. He had to work harder to stay ahead of those who were trying to copy or counter his strategies. He was under pressure like never before. Every loss felt bigger. Every mistake was magnified. At one point, Livermore admitted something that many traders never understand until it's too late. The market is never more dangerous than when you think you have it all figured out. The emotional toll of trading. One thing Livermore had come to realize was that trading wasn't just about numbers and strategy. It was a battle of emotions. When you win big, you feel invincible. When you lose big, you feel like a fool. And in both cases, your emotions can lead you into even bigger mistakes. He had seen countless traders destroy themselves, not because they didn't know how to trade, but because they couldn't control themselves. Livermore himself had struggled with this. Even after years of success, he still had moments where his emotions got the best of him. And he knew that if he ever lost control completely, it would be the end of him as a trader. The trap of overtrading. One of the biggest dangers Livermore warned about was trading too much. Many traders felt the need to always be in the market. They feared missing out on opportunities. But Livermore had learned that sometimes the best trade was no trade at all. He had made some of his biggest wins by waiting patiently for the perfect setup. But he had also made some of his worst mistakes by jumping in when he should have stayed on the sidelines. The market doesn't pay you for being active. It pays you for being right. Recognizing the shift in the market, Livermore started noticing something troubling. The market was changing again. Stocks were behaving strangely. The overall sentiment was shifting. People were getting overly confident, just like they had before past crashes. To most traders, things still looked fine. But Livermore had a feeling, a gut instinct that told him trouble was ahead. And if there was one thing he had learned over the years, it was this. When the market starts whispering warnings, smart traders listen. The next big move. Livermore knew he had a decision to make. Would he keep riding the wave, risking everything on the assumption that the market would stay strong? Or would he trust his instincts and start preparing for what might come next? He had been here before. He had ignored the signs in the past and paid the price. This time, he wasn't going to make that mistake again. The market was about to change, and Jesse Livermore was ready. Jesse Livermore had seen this pattern before. The market looked strong, investors were confident, and yet something felt off. He had learned to trust his instincts, and this time was no different. Something big was coming, and he needed to be on the right side of it. Spotting the cracks before the fall, Livermore had always believed that the stock market moves in cycles. What goes up eventually comes down, and vice versa. The problem was that most traders refused to see the warning signs. They got comfortable when prices kept rising. They assumed that just because the market was going up, it would keep going up. But Livermore had learned that markets don't crash when everyone expects them to. They crash when everyone feels safe. And right now, everyone felt way too safe. The psychology of a market top. One of the biggest lessons Livermore had learned was this. Markets don't turn because of numbers. They turn because of people. When investors become overly confident, they stop questioning things. When stocks keep rising, they ignore risk. When greed replaces caution, disaster is just around the corner. He had seen it in previous market crashes. The moment when everyone thought making money was easy was exactly when things were about to fall apart. And looking around now, Livermore saw the same signs. The party was about to end. Making the big short bet. Livermore had built his fortune by making bold moves when others hesitated, and now he was about to do it again. While others were still buying, he started selling. While traders were chasing the last bit of profits, he was positioning himself for the downfall. While everyone else believed the market was unstoppable, he knew better. He knew better. This wasn't just another trade. This was a moment that could define his career. Going against the crowd. Making a contrarian move was never easy. His friends thought he was crazy. Other traders mocked him for betting against a rising market. Even the newspapers were calling for a new era of endless growth. But Livermore had seen these headlines before. He had read similar reports before every major crash. He knew what was coming. And more importantly, he knew how to profit from it. Patience is the key. Livermore wasn't just placing his bet and walking away, he was waiting. A big trade needed perfect timing. If he was too early, he could get squeezed out before the crash happened. If he was too late, he'd miss the real profits. So he stayed patient. He watched. He waited. And then the market started to crack. The fall begins. It started with small drops, nothing major, just small dips here and there. The newspapers said it was normal. Analysts said it was just healthy profit taking. Investors told themselves that dips were buying opportunities. But Livermore knew better. This was just the beginning. Then, the small dips turned into bigger drops. Stocks that had been skyrocketing for months suddenly started falling hard. The same investors who were fearless before now started to panic. Margin calls hit traders who had borrowed too much. And just like that, the market was in full collapse. The aftermath. As the market crashed, Livermore's short positions exploded in value. While others were losing everything, he was making millions. While the newspapers were scrambling for explanations, he was counting his profits. While other traders were panicking, he had already positioned himself for success. He had once again proven that trading isn't about following the crowd, it's about thinking ahead. Lessons from the crash. Livermore had made a fortune, but the real value wasn't just in the money, it was in the lessons. 1. Markets don't move based on logic. They move based on emotions. 2. The best time to buy is when everyone is scared. The best time to sell is when everyone is greedy. 3. Big money isn't made by chasing the trend. It's made by predicting when the trend will change. This was one of Livermore's greatest victories. But he knew one thing for sure. The market would change again, and when it did, he would be ready. Jesse Livermore had just pulled off one of the greatest trades of his career. He had seen the market crash coming before anyone else, positioned himself perfectly, and walked away with a fortune. But in the world of trading, one big win doesn't guarantee long-term success. The real challenge is knowing what to do next. The trap of overconfidence. Livermore had been here before. After a massive success, the danger wasn't in losing money, but in losing discipline. Winning big can make a trader feel invincible. It can make them believe that every future trade will be just as easy. And worst of all, it can make them take unnecessary risks. Livermore had learned this the hard way in the past. He knew that his biggest losses always came after his biggest wins. So this time, he told himself, stay disciplined, don't let greed take over. After the crash, the market didn't stay down forever. It never does. Panic selling created opportunities. Stocks that had been overvalued were now trading at bargain prices. And the same people who had sworn off investing during the crash started jumping back in. Livermore watched carefully. Was this a real recovery or just a temporary bounce? His experience told him that markets don't go straight down or straight up, they move in waves. So instead of rushing back in, he waited. The power of patience. One of the hardest things in trading is doing nothing. Most traders feel the need to always be in a trade. They hate the idea of sitting on the sidelines. But Livermore knew that the best opportunities only come a few times a year. And right now, he didn't see a clear setup. So he did something most traders couldn't. He waited. The temptation of new trades. Even though Livermore was being cautious, the market was pulling him back in. Stocks were rising again. Everyone was making money. Even traders who had lost big in the crash were suddenly turning bullish again. Livermore started hearing rumors, the same kind of rumors that had led so many traders to ruin before. This stock is about to explode. This is the next big opportunity. You don't want to miss out. He had heard it all before. But even he wasn't immune to the emotions of the market. And soon enough, he found himself taking new positions. The danger of rushing in. At first, it seemed like he was on the right track. His trades were working. He started making money again. His confidence was growing. It felt like he was in complete control. But something wasn't right. The market wasn't behaving the way he expected. The rallies felt weak. Every time stocks went up, they quickly reversed. Then his position started turning against him. The reality check. Livermore knew he had made a mistake. He had rushed back in too soon. He had let the excitement of the market cloud his judgment. He had ignored his own rule of waiting for a clear setup. Now, instead of being in control, he was reacting. And when a trader starts reacting instead of planning, they're in trouble. Cutting losses and moving forward. Livermore knew what he had to do. Get out. He took his losses quickly. He didn't try to hope his way back to profit. He reminded himself that trading isn't about being right all the time. It's about managing risk. It was a painful lesson, but an important one. Even the best traders in the world make mistakes. The difference is how they handle them. Lessons from the chapter. 1. Big wins can lead to overconfidence. Stay humble. Stay disciplined. 2. The best trades don't happen every day. Learn to wait for the right moment. 3. Markets move in cycles. Just because prices are rising doesn't mean the trend has changed. 4. When a trade isn't working, get out. Small losses are better than big disasters. Livermore had made a mistake, but he wasn't broken. He would regroup, reassess, and get ready for the next big opportunity. And when it came, he would be ready. Jesse Livermore had just experienced another setback. He had let himself get caught in the excitement of the market, entered too soon, and taken losses. But setbacks weren't new to him. What mattered was what he did next. Would he learn from his mistake, or would he fall into the same trap again? The importance of self-control. One of Livermore's greatest strengths was his ability to self-reflect. Instead of blaming the market, he analyzed his own actions. Why had he entered too soon? What signals had he ignored? How could he prevent this mistake from happening again? Most traders let their emotions control them. Livermore refused to be like most traders. He reminded himself, the market doesn't care about my past success. It doesn't owe me anything. My job is to follow my system, no matter what. The market's next move. While Livermore was reassessing his approach, the market was shifting again. Stocks that had rebounded after the crash started showing weakness. The bullish excitement was fading. The same traders who had jumped back in were now feeling uneasy. Livermore had seen this pattern before. It was the classic cycle of hope, greed, and fear. But this time, he wasn't going to get caught in it. He was going to wait, truly wait, for the right moment. The setup he was waiting for. After sitting on the sidelines for weeks, Livermore finally saw it. A clear, undeniable short-selling opportunity. Stocks were struggling to hold their gains. Market leaders were showing weakness. The overall trend was shifting downward again. This wasn't about guessing. This was about recognizing the signs. He knew the market was setting up for another sharp decline. And this time, he wouldn't hesitate. Pulling the trigger, Livermore built his short positions carefully. He didn't go all in at once. He added to his position as the market confirmed his thesis. He managed his risk, staying disciplined even when the temptation to over-leverage was strong. Unlike before, when he had jumped in without a clear reason, this time every move was calculated. And when the market finally broke down, he was in the perfect position. The market crashes again. Livermore's instincts were right. The bullish recovery had been a trap. Stocks started falling fast. Panic returned to Wall Street. The same traders who had been buying the dip were now rushing to sell. Livermore, however, wasn't panicking. He was profiting. By the time the dust settled, he had made another fortune. This time, without making the mistakes that had cost him before. The key takeaways. 1. After a setback, don't rush back in. Step back, analyze, and wait for the right opportunity. 2. Self-discipline is more important than intelligence. The best traders control their emotions. 3. Market cycles repeat. The same patterns of greed and fear play out over and over again. 4. When the right trade presents itself, act decisively, but manage risk carefully. Livermore had recovered, not just financially, but mentally. And that was even more valuable than the money. The final lessons. Jesse Livermore had seen it all. Booms, crashes, fortunes made, and fortunes lost. He had played the greatest stock market game in history, outwitted some of the smartest minds on Wall Street, and learned lessons that few ever fully grasp. But as this chapter unfolds, we see the reality of trading at the highest level, a game that can reward massively, but also demand everything in return. The rise and the fall. Livermore had made another fortune by shorting the market at the right time. His patience, discipline, and ability to recognize patterns had once again put him ahead of the crowd. Yet, despite all his success, something deeper was happening. The weight of past mistakes still lingered. The pressure to constantly perform never eased. The battle between emotions and logic was always there. The market had taught him everything, but it had also taken its toll. The psychological burden of trading. Livermore had always believed that trading was more than just numbers. It was a psychological war. Fear, greed, hope, and regret played tricks on every trader. Even the best strategies failed if emotions got in the way. Success in trading meant mastering yourself as much as the market. This was something most traders never understood. They searched for secret formulas and magic indicators, but the real secret was discipline. The market doesn't forgive. Livermore knew from experience that the market never gave second chances. If you made a mistake, you paid for it. If you didn't manage risk, you lost everything. If you let emotions take over, you were doomed. Even after all his success, he wasn't immune. The pressure to stay on top, to always be right, had begun to take a toll. Final reflections. After decades of trading, Livermore had learned the ultimate truth. The stock market is never obvious. It is designed to fool most of the people, most of the time. His story wasn't just about money. It was about human nature, psychology, and the endless battle between discipline and temptation. Livermore had made millions, lost millions, and made them back again. But in the end, the greatest lesson he left behind was this. The market rewards patience, but punishes impulsiveness. No trader is bigger than the market. Discipline and risk management are the only true edges. The legacy of Jesse Livermore. Livermore's trading methods would go on to inspire generations. His principles of price action, trend following, and risk management became the foundation of modern trading. But his story was also a warning. The stock market is a dangerous game. It can make you rich, but it can also destroy you. Only those who respect it survive. And that's where his journey ends. But the lessons he left behind are more relevant than ever. Final thought for traders. If there's one thing to take away from Livermore's life, it's this. The market doesn't care who you are. It rewards those who are prepared and punishes those who aren't. So the question is, are you prepared? And that's a wrap on Reminiscences of a Stock Operator. This book isn't just about trading. It's about understanding the market, mastering emotions, and learning from experience. If you found these insights valuable, hit that like button, share this video with fellow traders, and don't forget to subscribe to the channel for more deep dives into stock market classics. Keep learning, stay disciplined, and trade smart. See you in the next video.